the first weekly review of 2025. Um, I'm not going to say Happy New Year because you should have been following me on Instagram, TikTok, even here on YouTube with all the daily nuggets. You know where we are. Let's get straight into it, guys. First trading week, three positions taken actually, one still holding, one loss, and one break even. Break even was a bit crazy though on USD JPY. It was floating about 3% in profit with stops at break even, waiting for a 15-minute break to the upside to adjust stops. And then one candle wiped out 3% and stopped me out at break even. And there was actually a buy opportunity later that day, but that would have been a high risk. It was a high risk position. So because I'm still in phase two of the trade building protocol, if which if you remember from last year is 4 weeks where I'm only taking low risk positions, then yeah, you'll know that I couldn't have taken that anyway. But yeah, so one loss, one break even closed, one position floating, euro odd. Um, Stops resting just above the mean threshold of this bullish order block. We'll see how this plays out. Think there's a potential to sweep that to the upside and then sell off. How far we sweep that remains to be seen. Um, or we could just sell off from open. We are in this little rejection block at the moment. So we'll see how that plays out. This isn't on watch at the moment. For the week, Euro NZD is. They look pretty much the same, but just a few small differences on Euro NZD, which led me to opt for that instead. So looking at the week, we took two trades, both met the plan. Um, what was the level of risk of each trade? Um, that's where we kind of fell off. Or JPY long. In the moment, I thought it was low risk, but it was actually a high risk position. Um, and when looking at why, I misinterpreted that in the moment. Definitely a bit of FOMO. It was the first trade of the year. Was itching for position, and so that wasn't really a technical inefficiency. That was all down to psychology and I guess just being a bit too excited to take a position and rushing into that without um, seeing it for what it was, which was a high risk position. And maybe part of me knew that, look, if I acknowledged it was high risk, then I couldn't have taken the position. And so I will be restarting from the first week, this coming week. Um, yeah, of phase two, because remember, if I take a high risk position or an invalid position, then I start from week one of only taking low risk trades. So yeah, second position, USD JPY long, that was low risk. That was quite a good trade. But yeah, that ended up closing up break even. What did I learn this week? Carrying on with the ICT mentorship. Um, and yeah, yeah, and I was working through, so, and yeah, I worked through or learned about propulsion blocks. The whole of month four is basically a deeper dive into order blocks and the different types of order blocks and propulsion blocks, basically an entry model that can be used for initial entries as well as scaling into a position. And it can be used for more conservative entry as it waits for a push in the direction of the bias before then a retest of the order block, which is a propulsion block. And what makes it a propulsion block, or one of the criteria, is that the mean threshold stays intact. And so it's really, I find it maybe useful for continuation positions where the confirmation of a shallow mitigation can give then confirmation of or that it's a valid, propulsion block. So hence can be used for scale-ins. And then what's the most important thing I need to work on improving this week? Probably managing expectations when it comes to trade frequency and outcome. Want to start this year the same way I ended it literally the last day, where if you remember from the previous review, a big takeaway was just how calm I was in that position I took on that Friday because there was so little expectation attached to it. So want to continue managing those expectations heading into this new week because there is an abundance of opportunities. But yeah, also don't want to rush into positions or mismanage things because it's going to be early in the week. We're still arguably very early in the year. And yeah, just want to take it as it comes. And what the most important thing I should continue doing this week is staying consistent with the daily nuggets and ensuring that the observations and insights are actionable tweets I can implement immediately. Because I think that's where the most growth lies, is sharing tweaks and insights that will help me improve my trading today, not at the end of the month, not at the end of the quarter, but right now for this upcoming week or this day. So yeah, really want to just continue posting those and just implementing, yeah, the lessons that I'm putting out there. So just looking at the Alpha Capital account, just for that accountability, you can see same account, same start date, current balance, yeah, sitting at about 3.4% drawdown. So that's just that one position from this week that affected that, because the other one was a break even, so that would have been flat in any case. But you can see it's the same account. We are still moving. I just want to chat briefly around what changes I've made to my trading plan going into the year. And if you've been following the daily nuggets, you'll know that the first bit of it was touching on my trade management. So there is a revised trade management model that I'm currently testing based on that. The current insights and observations are around the number of pairs I trade. And so really working through it, that speaks to the environment where the pairs I trade are defined by my watch list folder. There's 26 of those on TradingView. Each week, I filter this large watch list down to 4 pairs, which I will focus on for the upcoming week. Big change because of all the reasons explained in that first observation. And so my high time frame execution process really still looks the same, where I'm looking at the daily, I'm looking at whether price has mitigated EPD or not. And if we have, what direction the 4 hours in, because I need it to either be trending, counter to the daily bias or with the daily bias. And then again, whether my entry is counter trend or pro trend to that 4 hour trend. And that obviously has a whole bunch of criteria on its own. But even if price isn't at that daily EPD, I just need a trend on the 4 hour to be established towards EPD, because then I can still look for those counter trend resistance entries. And I find I've been getting a lot of those. If anything, those are probably the trades I take the most. And so, yeah, not much change to this, because obviously the number of pairs I trade won't affect this too much because I still apply the same process. And yeah, as well with the way I manage the positions, it has no bearing on this. So when looking at my parameters, these have stayed the same. There is a small difference with my lower risk 1 hour EPD entry, which basically says that price needs to retrace deeply to the 70.5 or 79% fib level of the corresponding 1 hour range, and it needs to do so without protracting with displacement, which forms one-sided 1 hour fair value gaps. The entry is also taken after prices mitigated a 1 hour or 4 hour key indicator area and swept 15-minute time-based liquidity within the key indicator area at least once. Something I added onto this was that for optimal alignment entries, which are basically entries where the daily has mitigated EPD and the 4 hour is now trending in alignment with that daily, those are my optimal alignment entries. For that, price does not have to mitigate a key indicator area for the trade to be low risk, but does need to adhere to the rest of the low risk criteria, which is basically retracing deeply to the 70.5% or 79% region, as well as then an internal or a lower time frame time-based liquidity sweep. That speaks more to the parameters. For my 15-minute IPDA entry, this has remained the same. And so when I come now to my trade parameters, this hasn't really changed either. Obviously, I've got the one condition for my optimal alignment entries, but this is still the minimum criteria for all other trade setups. And then looking at my trade management now. So in the Daily Nuggets, I explained the 3 different management strategies I was testing against trades taken, which were my current, the alternative strategy 1, as well as Casper SMC's price weighting method. What I have decided to use as a management strategy, or test rather, is maybe a blend of all, where once price reaches 1R, I still now apply the half risk method. So no longer 2R now. This is basically what my current or previous plan had. So 1R is half risk is applied at 1R. At 2R, I apply break even. But the key difference now is that I don't take partials at 2R. I just leave the full position on, but the break even method is adjusted, is applied. At 2R, I also then look to trail my stop conservatively on the 15 and 1 hour timeframes instead of waiting for this to get to 3R, which was what the alternative strategy kind of stated. And then I still identify a target area, and once price reaches that target area, I apply the price weighting strategy. And so it's actually a combination of all 3 of the strategies I was testing, because when I was looking at the data, I obviously had the results of each, and there were pros for all, cons for all, and I then created an alternative management strategy 3, which kind of took the best characteristics from each, which was, I guess, the aggressiveness of my current or previous strategy in reducing risk, as well as the element of the alternative strategy where I'm letting my winners run and I'm not choking my trades or handicapping them by taking partials. And when I looked at the same sequence of results for this alternative management strategy 3, it produced better results than my previous or current strategy. Didn't perform as well as the alternative management strategy 2, but I also didn't have to undergo as much of as many consecutive losses as the alternative management strategy 2, because that is still, I think, a big thing where a healthier sequence of results is very, very important and not something that I should just look at very lightly and think that if I'm 8 to 10 losses, you know, if I'm 8 to 10 losses in, then it's not going to have any bearing on how I'm executing. So trying to find common ground between what worked well and what didn't. And that's what I ultimately came up with. And so those were really the only changes from the six-figure plan going into Q1 of this year. And the last thing I just want to share with you guys before we wrap this up is basically how I look at my monthly ranges. So looking at the same two pairs that I was discussing in my insight, pound NZD, order NZD. When I look at my ranges on the monthly, it looks at the most recent candlesticks, which define either the low or high of the range. If it's a bullish range, it's going to be defining the low. If it's a bearish range, it's going to be defining the high. Why? Because looking at this bullish break to the upside, I basically see that, and then that helps me identify then a fresh order block, in this case, a bullish order block that's just printed, and the high or open of that candlestick determines the low of my range. And then looking to the left, the next bullish candlestick's low or open determines the top of the range. And above that, above current price action, we then have the low of this bullish candle, which then determines our range high. And so looking at ORD NZD, you can see that price has been quite corrective for the past few months, and we cannot, within this corrective phase, establish what the most recent range, high or low, is in this case. And only once we get a displacement from price will that become a lot clearer, because we could break to the upside and target these highs here. Remains to be seen. Just because we have been correcting doesn't mean we can automatically assume we will be trading lower. Even though that's the bias, until we get that sponsorship or that commitment from price, then again, it's all just analysis at the end of the day. So the definition of the range isn't so clear here because of how corrective price has been trading. And that's why I opted to go with pound NZD, because it's in a clear trend at the moment, and defining those range parameters required a lot less discretion, which is what I'm trying to lead with this year. I think it's a big intention of mine. Sometimes we try to project what we're seeing or what we think is going to happen onto the market. But when you're looking at a pair, and so if you have a plan and your plan is very clear, and then you get to the charts and you're looking at a pair, there shouldn't be too much guesswork. Yes, there's always going to be an element of discretion in terms of whether, a zone starts from this price point or that price point, and, all those nitty-gritty things, but you shouldn't be thinking too long and hard. And when you're starting to think too long and hard around where the trade setup is or how to define parameters, or then there's just no position there. If it's not slapping you in the face, it's not there. And pound NZD was clear. As soon as I came up to the monthly, I could plot it very quickly. Order NZD, on the other hand, there's a lot of ish, but yes, it looks good from this. And once you start doing that, leave that pair, check it in a week. You'll find it's developed, and you can maybe make more sense of it. So I hope that gave a bit of clarity into the monthly range method. If you want to just see one more example, I've got pound JPY, which you can use. And so you can see, so for here, the last 1, 2, 3, 4, 5, and then we're in the 6th month, have been corrective, and that speaks to the corrective phase we've been in on pound JPY. But we've also mitigated the range high or where we should have been looking to sell after this impulsive bearish candle, which established this bearish order block. So we reach that candle's low, which is our range high. And you can see for 1, 2, 3, 4 consecutive months, we tested it and rejected from it and have been testing it to a lower degree. And then if we look to the left, we look at the first bearish candle below current price action. And that's this candle here. And we can either use the body or the high. In this case, I've just gone with the body. There's not much difference. But you can see then there's a clear range then from this point down to this area here. And that's even a conservative target because price could ultimately end up down there. And so that in a nutshell is how I define my ranges and why some pairs were filtered out this week as opposed to others. Remember, guys, consistency is the choice you make when you start doing the things you know you should be doing day in and day out.